Welcome to this session on doing relative valuation. What we're going to do is we're going to take you through how to value a company based on the valuation in the stock market of its peer group. And we're going to take a look mostly at an enterprise value multiple, which is a multiple of the whole firm value divided by earnings before the cost of capital, in other words, before interest. And we will look at the mechanics of doing that and using our Felix platform, which allows you to learn how to do this, but also apply it. So let's get started. Relative value is also known as trading comparables. Typically, relative value is a term that's used on the trading floor, and trading comps or trading comparables is used in investment banking or corporate finance. We're going to do a company called Kellogg. So I'm going to go to Felix, click in Company Analytics, type the letter K, and then choose Kellogg, and it will bring the tear sheet for Kellogg. We actually already have a relative value matrix here, and you can see what's happening is that Felix is giving us a list of comparable companies here. And we've got a list of 5 other companies, and we've got a whole load of metrics. But what I'm going to do is I'm going to add a couple of other companies that I want to include here. And the first one is going to be Mondelez, and I'm going to add that to the grid. And then I'm going to go down and add Tyson Foods as well, because I think that's a good comp. And I'm also going to add PepsiCo as well. And I just want to check we've got ConAgra Brands in there. Yes, we do. General Mills. Now, if I look at this comp set, you can see that most of these firms are pretty large. A couple of them, the Simply Good Foods Company and Treehouse Foods, however, are pretty small. So what I'm going to do is I'm actually going to exclude those. I'm just going to take those out. And the reason I'm going to do that is that this will affect the medians. Now, the grid is split into 2 components. The first component is a valuation component, and that covers the first 5 columns. So it's the market capitalization, the value of the equity in the market at the moment. And currently Kellogg is valued at about $21.5 billion. It's trading at a revenue multiple of 2 times and a CY1 EBITDA multiple of 12.6 times. CY1 just stands for calendar year 1. Now, we're doing this as of December 22nd, 2021. This means because the year end hasn't closed, CY1 actually would still be 2021. So it's always the kind of forecast year. And then the same thing for revenue, so CY1 revenue. Now, one of the key things that people find challenging is firstly what multiple to use, revenue or EBITDA. Companies that are profitable generally would trade on a multiple of their earnings, and these are pretty slow growth companies. It's the food sector, so I would focus on the EBITDA multiple rather than revenue multiples. If the companies were very fast growing or loss making, then maybe you choose revenue, but in most cases EBITDA is a key metric. The reason people like EBITDA rather than EBITA or EBIT is that the DNA is non-cash, but there's actually a more important reason. And that is because if companies have grown by acquisition, and in this list, the companies that have grown by acquisition are PepsiCo and Mondelez for sure, they will have had an awful lot of assets that have been revalued on the balance sheet. All the brands that have been acquired will be put on the balance sheet and amortized, and all the fixed assets will be revalued, and all that revaluation will be depreciated. So that means that Mondelez and PepsiCo would have a lot more depreciation and amortization because of the acquisitions. And the EBITDA adds that all back, and so it puts acquisitive companies like PepsiCo and Mondelez on the same level playing field as someone like Kellogg and General Mills. And that's why it's such a popular metric. The other issue is, why is Kellogg trading at 12.6 times when PepsiCo is trading at, let's say, 18.8 times? That's a significant difference. And even Mondelez is trading at 17.9. Now, sometimes this can be about size. So you can see that Mondelez is worth 90 billion and PepsiCo is 236 billion. But Kellogg is still a pretty sizable company at 21 billion and General Mills is nearly 40 billion. And they are at a significant discount. So this is why we've got these other two columns. We've got margins and we've got revenue. And actually you can do some math because behind a multiple, you can use returns, cost of capital, and growth to derive a multiple. So the market puts a really high premium on growth. And you can see here that if we look at the list of companies here, the two companies that are growing fastest, PepsiCo and Mondelez, are also trading on the highest multiple. So you can see there's a direct relationship between growth here and the multiple the companies are trading on. So it's not necessarily correct to say PepsiCo and Mondelez are expensive because actually what you're paying for are earnings that are going to grow much faster than the other companies in the sector. In addition to that, not all growth is the same because companies' margins are different. So if we take a look at Tyson Foods, they have margins of about nearly 12%. Now they're growing at around 4%, which is significantly higher than Kellogg, getting on for double. They're higher than General Mills as well. And they're also higher than Conagra Brands. But the problem is each dollar of additional growth from Tyson Foods is probably only generating 12 additional cents in EBITDA. Whereas if you're Conagra, it's generating 21 cents in additional EBITDA, and for Kellogg, 16 cents in additional EBITDA. So actually, the growth of Tyson, or the growth that we're seeing in Tyson, is less valuable because its margins are lower. Because typically, if the margins are lower, you're going to get less margins of the new growth. Not always, but usually. Now you can see here that PepsiCo have got these fast growth rates as well as Mondelez, and their margins are among the highest in the sector. Certainly Mondelez is. It's got the highest margins, not the highest growth rate, but the highest margins and a pretty robust, actually not quite as high as Conagra Brands. So I'm not surprised that PepsiCo and Mondelez are trading at such high multiples because not only have they got the strongest growth in the sector, but they also have the best margins. So you can start to see how the market's working here. They're saying we're going to pay a lot more for PepsiCo's earnings because not only is it growing faster, it's got higher margins. And higher margins mean also that the growth is more valuable, but also the business model tends to be more robust. You've got more kind of competitive advantage, which is why you can achieve higher margins. And that will either be because you have more pricing power, or it will be because you have better cost structure. So if we look at this grid, and you can see that Kellogg is trading at about 12.6 times, that's a little below the median. The median only includes the comparable companies. It doesn't include Kellogg. And the growth rate is slightly below the median. So that probably kind of stacks up. And the margin is actually below the median as well. So actually, I would expect Kellogg to trade on a slight discount to the median because it's got lower growth rates and it's got lower margins. Now, what I can do, if I just copy this, I can then put it into Excel. And if I just pop it in here, I'm going to do a little bit of a cleanup. I'm just going to remove the X's on the multiple here. So I'm just going to replace them. There we go. And I'm going to do the same with the leverage multiple as well. There we go. Let me just replace that as well. If you do want to put X's in, the best thing to do is to do it in the formatting. So I've just changed the number format so it has an X. And if you want to put a space and then X, you need to put the X in quotations. So that's what I've done there to make sure that those are multiples. So here we have got Kellogg and its peer group. Let's assume we're going to revalue, or let's assume we didn't know the value of Kellogg. So if we didn't know the value of Kellogg, what we would be able to do is use the peer group. And ideally, we would take another company which has similar growth rates and margins to Kellogg. So we're looking at somebody who's not the top of the track in terms of margins. And certainly Campbell's Soup is pretty similar. Conagra Brands is actually better. But if I look at the growth rates, that's probably more important than margins. So if I look at the growth rates here, certainly PepsiCo and Mondelez are growing much faster. General Mills is pretty similar. Tyson is faster. Conagra Brands is pretty similar. So I probably, if I didn't have a value for Kellogg, probably would put someone like General Mills and Conagra Brands as my two comparable companies that I'm going to use to value Kellogg if I didn't have a valuation for Kellogg, if it was a private company. So what I'm going to do here is put the high enterprise value to CY1 EBITDA, and then I'm going to put the low enterprise value to CY1 EBITDA there. And in this case, I've got my two companies. The high is the General Mills 13.9. The low is the 10.8 from Conagra. Now, I'm actually going to just change this layout a little bit. What I'm going to do is I'm just going to move that to the right, and I'm going to move this down here, and that's going to be the high, and this is going to be the low. There we go. So I've done that. And then let me just wrap the text so that looks a little bit better. And I've preset some of the formatting. There we go. And just right align it. So I've got my, actually I can just do CY1 or EV to CY1 EBITDA here. And that can just be high and then low. That's actually a little bit clearer, isn't it? So those are the numbers I'm going to use. So then what I'm going to do is I'm going to get the CY1 EBITDA for Kellogg. And I'm going to pull that. I'm going to go back into Felix. Let me just insert some rows here because I want to get the consensus estimates for Felix. And down at the bottom, we've got the consensus estimates. So let me just pull that into my spreadsheet. And I've got some rather annoying formatting, so let me just change this. There we go. I've got some rather annoying formatting, so let me just change it. It's better. And we've got our growth rates there, and we've got our margins there. We don't really need to worry about the EPS, so I'm just going to remove the EPS. So I've got my consensus estimates there. And luckily, Kellogg has a 31st of December year end. So our CY1 year is the 2021. And my EBITDA for Kellogg, the forecast EBITDA, the consensus forecast from research analysts, is 2282. So I'm just going to copy that and I'm going to put it down here. And this is actually going to be the same for both of our valuations. And then I'm going to calculate the implied EV, so the implied enterprise value. So I'll take the multiple from the comparable, multiply it by the EBITDA for Kellogg, and let me just make this super clear. So these are hard-coded, and the high company that we're using here is General Mills, and the low is Conagra. So this is General Mills, and get that capitalized. And this is Conagra. Okay, because in banking, we will always do a range. You'll never just have one number. Now, then what I want to do is cross the bridge. And so I'm going to go back to Felix. And I'm going to get my equity to enterprise value bridge because it's got all the numbers I need there. So let me just paste that in. And I'm going to just add a little bit of room. And then I want to cross the bridge. And the first bit of the bridge, the financial investments. So let me just move those up. So I'm going to add that back. And this is, again, it's going to be the same for both because we are going to cross a bridge for both of them. And then what we need to do is we need to subtract the net pension liability, subtract the debt, and if you want to find where these numbers are coming from, the nice thing about Felix is you can just click through in the number. So, for example, if you wanted to calculate or find out where the net pension liability is being calculated from, if I go back to Felix, I can just click here and you can see all the numbers are here. If I click on pension assets, it takes me directly into the place in the filing where this number is coming from. Just fantastic. However, I'm now going to do the implied valuation and I'm going to cross the bridge. Now, you've got to remember that you have all the assets on one side, which is the enterprise value and the financial investments, and then all the claims on the other side. So the implied equity value, because we're going to start at enterprise value, the enterprise value, the financial investments and the cash, minus all the other claims ahead of shareholders, the pensions, the debt, and the non-controlling interests, the NCI there. Hit enter, and that gives me my implied equity value. So what we're saying here is that if Kellogg wasn't quoted, we would probably value its equity at between $17.3 billion and $24.3 billion. Kellogg currently is trading at about $21.5 billion. So it certainly looks as though it's kind of fairly valued. The only hesitation I have there is that it's growing at a faster pace than both General Mills and ConAgra, although its margins are weaker. Now, on balance, I think the market probably puts slightly higher focus on growth, so I probably would be happy with it trading towards the higher end of that valuation range, and it is at the moment $21 billion. So this certainly makes it look like Kellogg is a kind of fairly valued company based on the relative value or the trading comparables. So that's a little trading comparables using Felix. Thanks for watching.